Hi, everybody. Lance Browning, Income Solutions Wealth Management in Tyler. We realize that it is way too early for the halftime report, but we did want to reach out to you, give you our voice, our thoughts on what's going on in the world around us right now. Keep in mind, this is my 23rd year in practice. This is not my first, second, or 30th rodeo. We have seen these types of things before, and I rest assured we will probably see them again. The tough times that global markets were experiencing due to the spread of the COVID-19 or coronavirus worsened this past weekend as a price war between Saudi Arabia and Russia resulted in sharply declining oil prices. This combination of events is testing investors' patience and probably their sanity. We need to remember that it is fairly common for stocks to enter bear market territory, defined as a cumulative drop of 20% or more, without being in a recession. In fact, market drops are often more fueled by fears of recession rather than a recession itself. While there are certainly concerns that are eroding investor confidence, we should not lose sight of the potential positive catalysts and the countervailing forces to an otherwise nervous market. First and foremost, when stock prices fall significantly, markets are not only pricing in bad news, but also providing an entry point for long-term investors. Secondly, markets have built-in shock absorbers, since short-term negative news can often lead to longer-term positive outcomes. For example, lower oil prices will eventually result in lower gas costs and more money in the pockets of consumers. One common market axiom is that the first cut is the deepest, which implies that when concerning news first breaks, like the first reports of the spread of COVID-19 or a major drop in oil prices, markets immediately react intensively. But each additional piece of news becomes less impactful. In other words, the news doesn't have to be good to lift stocks, it just has to be less bad. To apply this to what we are currently experiencing, historically in pandemics, and we've had these before, again, stocks have usually begun to recover as the number of new diagnosed cases stabilizes, not necessarily even declines. In times like these, our natural inclination can be to sell into the panic. But we all know this difficult environment, while it is scary for all of us, we get it, it's temporary. History has taught us that rampant volatility creates opportunities. We experienced this again in 2008, 2011, 2016, and most recently, the fourth quarter, December of 2018. When prices disconnect from underlying fundamentals, which they have, invariably the best decision for long-term investors has been to stay the course. Though it can be difficult to focus on the long term at times like these, we believe that this is one of those situations where eventually we will look back at it as a unique opportunity. Envisioning ourselves in position in the future isn't easy right now. It was hard to see green shoots in the economy in 2008, when few could envision the emergence of a positive market coming out of that financial crisis. Those who sell in a market storm rarely notice when the storm clouds begin to lift. And as investors, missing those stock market rebounds is probably the biggest risk to achieving our long-term goals. Now, we don't know exactly when this market will find a bottom and reverse course. Obviously, they don't tell us that ahead of time. Markets are facing a crisis of confidence, but our confidence in the long-term fundamentals and prospects for the U.S. economy and for corporate America is unwavering. We will get through this. We believe that patience will be rewarded. Please stay healthy. We like you, and contact us if you have any questions or concerns. God bless.